We explained earlier the Reserve Bank Deputy Governor Michelle Bullock gave a speech today observing how households are well equipped in her mind for raising interest rates. Now, by coincidence, S&P Global Ratings today issued a detailed report on the state of Australia's residential mortgage-backed industry. The banks and other lenders, in other words. Its primary analyst, Erin Kitson, joins us now on the program. Erin, many thanks for your time. I mean, it's one of these things where Michelle Bullock and the Reserve Bank, they're hopeful at least that there is no meltdown in property prices that causes a financial crisis. But in the meantime, if people have got jobs, if people can keep paying mortgages, technically all of the balls should stay in the air.
Look, I think that's correct. Certainly interest rate rises are going to put pressure on households, and we are all expecting mortgage arrears to increase in the months ahead. But the starting position leading into this, certainly from a macroeconomic perspective and system perspective, is a strong starting position. We have historically low unemployment at 3.5%, a strong build-up in household savings for many, many borrowers, and prior to coming into the pandemic, a progressive, tightening in lending standards. So whilst there are no doubt borrowers and a small proportion of borrowers who will struggle with meeting higher mortgage repayments as interest rates continue to rise, overall the mortgage sector is in reasonable shape to weather a certain level of interest rate rises.
Because one of the things that you look at here, you're looking at the safety, the security of the lenders, because, of course, any lack of security there could trigger a financial crisis, which is what we saw in the global financial crisis in 2007. So what you're trying to see are the hints that if house prices fall, people suddenly default on mortgages, whether that has a knock-on effect. But what you're saying right now is there's plenty of strong buffers inside the financial system to be able to cope with any price falls.
That's correct, and I think I mentioned a few of those buffers in my opening comments. But in addition to that, if you look at the loan-to-value ratio profile across, certainly we look at the residential mortgage-backed security sector, but also the broader mortgage market, the proportion of loans with high LTVs is not significant. That means a lot of borrowers have built up equity in their home loans, and that's another buffer, if you like, that helps against falling property prices, but also against rising interest rates, because one of the things that an equity build-up in your home loan allows you to do is it increases your refinancing prospects, which is a common way for many borrowers to voluntarily self-manage their way out of mortgage arrears.
OK, so you put up today the worst performing postcodes in regards to it. Was there any sort of commonality between those postcodes when it came to the characteristics of those households?
I think probably I would say at a high level, no. But I think if you look at that particular snapshot, if you like, over time, what's interesting is the change in the makeup of those postcodes. So if you go back pre-pandemic, that list, which we publish every quarter, was predominantly dominated by a lot of West Australian and Queensland postcodes, given the prolonged impact of the mining downturn on mortgage arrears in those areas and the difficulty, given that the house price falls that occurred, particularly in WA, made for borrowers to kind of exit their way out of mortgage arrears. So you would consistently see quarter after quarter a very high proportion of WA postcodes in that top 10. Post-pandemic now we're seeing more of a mixture of postcodes across the country as opposed to a predominance of WA and to a lesser extent Queensland in that data subset.
OK, so let's pick up the grab from Michelle Bullock today, talking about this and talking about the fact that she believes it will take significant house price falls before, again, there would be an impact on households and therefore on financial institutions.
While housing prices have started falling in recent months, they would actually have to fall a fair way for negative equity to become a systemic concern. So this low incidence of negative equity reduces the likelihood that borrowers will enter into default, as well as the size of losses incurred by the banks and the lenders if they did fall into default.
And Erin, this is the key for you, isn't it? Because it is the number of people that might enter into negative equity and then be forced to sell because they lose a job, because they get divorced, because a business busts up, because that's when the financial institution would really have to take the pain.
Yeah, and I think that, obviously that the negative equity is going to lead to losses. So the higher proportion of those types of loans in the system, the bigger the bank losses. But I think, I think taking a step back from that, Ross, I think the precursor to selling a home is defaulting on your mortgage. And probably the more important statistic there than the property price decline is unemployment, because unemployment probably has a higher correlation with mortgage defaults. As long as you have a job, even though your property falls in value, it doesn't mean that you're likely to default on your home loan, provided that your employment and your income hasn't changed.
Erin Kitson from S&P Global Ratings, good to have you in the program today. Many thanks.
Thank you.